You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Tuesday. Today, I want to go back on my Manoeuvre portfolio, mostly because it's been about 2 years that I'm doing that. Actually, like 3, but I took a break in between, so I was not adding capital. Reason being, when you do leverage, you must always make sure that you're in top shape financially. And when I came back from hiking Mount Kilimanjaro, well, that was an expensive trip. And I decided to take about 6-7 months off from not adding money to the Manoeuvre account and actually paying down the trip instead. So always try to manage your liquidity accordingly. And of course, using leverage or using the Manoeuvre is not for everybody. So long story short, Manoeuvre is the process of transferring your mortgage into a tax-deductible mortgage. So how do you do that? You have 2 accounts where you have the first account is your mortgage, and the second one is whenever you're about to pay capital on your mortgage, you withdraw money from the second line of credit account where you then put that into the stock market. So that portion of capital that you would have paid on your mortgage is now being reinvested. And since you borrow the money from a line of credit account to invest, the interest is tax deductible, and you can use the dividend income to the interest can be used to reduce your dividend income. So today we are looking at my portfolio. The current balance is $10,571. And I invested $10,000 so far. So it's easy to track my cost because I see that every month I put $500 away and I put that in my Manoeuvre account. It is a margin account, so if I ever see an opportunity, I can borrow a little bit on the margin, which also facilitate all the trades. So over time, I've built a portfolio of 10 companies, all Canadian, across 7 sectors. So well diversified across many sectors, well diversified across many companies, but I'm having a hard time finding businesses with a generous yield that still meet my investment criteria of having a strong dividend triangle. So far the portfolio is yielding 5.2%, but my cost of borrowing has increased to 7.22%. So of course, whenever we're going to have a interest rate decrease, it's going to be welcome on my side. But I mean, I knew about that, and the point again is to have a long-term mindset, not a short-term one. So short-term, after those 2.5 years or something, investing strategy, I don't show that much return, and it costs me more than I generate in dividends. So after 2 years, it's not really worth it. But when you leverage, it is a long-term strategy. You must have an investment horizon of at least 10 years. That would be, in my mind, the bare minimum to do that. So far, not so good in terms of it's not adding much to my net worth. However, there is a major advantage here is it forces me to put $500 aside every month. So while I keep up with my budget, that $500 goes aside and is being invested. Of course, it has a cost to save that money aside, but it's a good way to force saving whenever you can afford it and you can afford that liquidity. So for the year moving forward, I can forecast a dividend of roughly between $550 to $600, depending on how fast it grows. The average yield's at 5.2, but the average 5 years of dividend growth from the company I have in my portfolio is actually 7.81. So I still managed to invest in many dividend growers that were relatively generous over the past few years, and that enables me to have a good dividend growth rate, even if the yield is relatively high. The problem is even if it generates 5%, I would not necessarily be comfortable to say it would be a great retirement portfolio, because still there are a few riskier play, if I can put it that way. So you just have to be careful with that. I have my largest holding, for example, is Exchange Income Corporation, EIF.TO. The yield is at 5.7%, which is pretty high. And I have like almost 14% of my portfolio in this one. But it is a small cap. It is cyclical. So if there's a recession or anything, it could go wrong. The dividend triangle is not that bad. The revenues are increasing a lot. The earnings per share are slightly increasing, but it could be better. The company took a few pause in their dividend growth policy, but have been increasing it in 22 and also in 23. So after COVID, which is pretty good since the company is roughly half aviation and half industrial manufacturing plants. You can tell that the aviation business should not have been that great during COVID, of course. The second largest position I have in my portfolio is TELUS. So I doubled down on TELUS a few times. Now it's like almost 13% of my portfolio, offering a yield of 7%. So of course that helps to boost the yield. But the performance is not really there. So my average cost is like $24.60. The current price is around $22. So I'm not making money on this one right now, but my goal is to see that flipping around, since the cash flow metrics are getting better and better every quarter. So hopefully with a drop in interest rate and a company that continues to go on the good way to have enough cash flow to cover the dividend. The cash payout ratio was at 91% last quarter. So it's not amazing, but it is enough to cover the dividend as opposed to Bell. So I'm still very confident on this one. The third position in my portfolio is Canadian Natural Resource. The yield is lower, so 3.82. Of course, I'm making money on this one. So my average cost was 86, and now it's trading above $100. So that's great. It's almost 11% of my portfolio. So what it means is I invested like twice $500 in it. So now the value is a little bit over $1,100. So doing well on this one. I kind of liked the exposure to energy, especially because this one is paying down debt, buying back shares, and increasing the dividend on top of that. So this is an interesting play. The yield is lower, but it is definitely worth it to move forward. And even if it means that I'm going to have like a lower income from the Smith Manoeuvre, where maybe at one point the interest rate will actually be lower than the dividend yield, which is kind of like the case, like the goal, it's still going to be worth it from a total return perspective. Now, the fourth position is Capital Power. I also invested about 10.5% of my portfolio in it, 6.5% yield. Slightly in profit on this one, not too much, but still pretty good. This one is a long-term play. Of course, there's a lot of uncertainties around utilities in general. They have been beaten down pretty badly. CPX made a lot of has a huge capital expenditure projects. They spend a lot on acquisition. So of course it kind of like raised eyebrows at this point. It's going to take a while before it recovers and goes back into real growth mode. In 24, expectations for earnings are not that great, which is normal considering all the acquisition they're making. But going forward, I think it's going to be a very nice play where they diversify their business. They are less dependent on Alberta, and they go a little bit more onto natural gas, looking at the US market. So I kind of like the strategy over there. We're going to close that podcast with my my fifth position, TD, at 10%. So the yield's at 5.28 right now. They ran into their fair share of problem as of late because they are stuck in an anti-money laundering problem. The investigation is ongoing, so right now we don't know what's going to happen next. at this point, I don't really mind on my side because, I mean, let's be honest, it's $1,000 invested in TD. TD is not part of my other portfolios. So if it crash and burns, I don't think it's going to go bankrupt, of course. But if it goes down by 20 or 30%, it's not going to make any difference on the bigger scale. But on the other side, I think that the risk was well worth it. So, all right, Moose, I hope that you have enjoyed this quick update on my Smith Manoeuvre in my top 5. Let me know if you want to have more of that. You can reach me on Twitter at The Dividend Guy. Super easy. You can send me DMs. My DMs are open, or you can just send me any tweets my way. It's going to be my pleasure. So take good care. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.